the quarterly number wasn't in line with what we were expecting. It's a touch softer. But when you look at the year-ended number, it was bang on what we were expecting, that 2.6% year-ended growth rate. And that means there were revisions to previous quarters. So this upturn that we're seeing in the Australian economy actually has a lot of momentum that's been building over the previous quarters. And the ABS has just found a bit more activity in those previous quarters. So in terms of what it's telling us, that domestic demand impulse remains quite strong. And we're seeing household consumption, we're seeing business investment start to pick up on the back of improving incomes. So we saw the labour market, for instance, in the second half of last year, start to, I wouldn't say retighten, but the easing we were seeing over the first half came to a halt. So that's boosting incomes, and we're seeing consumers spend. The other thing that's quite noticeable is that over the first half of 2025, we saw public spending go backwards, but now that's done a reverse, and we've seen public spending actually contribute quite strongly to growth as well. So spending's firing on all cylinders, and that's what we're seeing when it comes to demand and growth in the economy.
Yeah, and so when you look at per capita GDP, the growth or the output divided by all of the people in the economy, essentially, in very simplistic terms, that's actually risen as well to 0.4% in the quarter. So the pie, if you like, is getting bigger, but it's also, people are also getting a bigger piece.
Yeah, that's right, and that's a positive development. We'll also see a bit of a turnaround in per capita consumption. But at the end of the day, this is all possible on the back of improving productivity. We need productivity to get those per capita numbers improving. And that's another positive development we saw, I guess, from the accounts today. So we saw productivity grow by 1% in annual terms. I haven't looked through the detail, but I suspect in the market sector, productivity would have been slightly above that in annual terms as well. And that's kind of where we were pre-pandemic. So we've recovered to where we were pre-pandemic. If we want stronger growth in living standards, we need to go beyond that. But that's a positive development that I guess will please the Reserve Bank, because if we have more productivity, the cost of production comes down and it helps the bank fight inflation.
Yeah, and I want to get to that idea of capacity constraints because we have been talking about the economy hitting its speed limit. Supply can't meet demand. We've got this capacity constraint in place, and that's why we're getting inflation. Does that productivity number indicate to you that that might not be quite as bad as we thought it was?
Definitely. You got to remember that these accounts reflect activity and productivity in 2025. So it did suggest that we did see this gradual easing in the labour market and a pickup in productivity on the back of that. So it does suggest that the RBA's view is quite pessimistic, and maybe the economy can sustain a growth a bit above where the RBA thinks, potentially is, just given those accounts. But as I said, these accounts are largely backward-looking. They reflect what happened in 2025. And I guess the real uncertainty is what happens going forward. If we have a retightening of the labour market, which is a risk given how strong demand has been, you could see that productivity and like the economy's cost base or labour costs start to re-accelerate or I guess halt its moderation, and that would worry the Reserve Bank. So 2025 was actually a good year when it comes to productivity. It did improve compared to say where it was in 2024. But the real test is whether that can be sustained going forward, given what we're seeing in demand, and given that we know that's going to translate into stronger demand for workers in the labour market.
Yeah, so that sort of idea of the strong demand and the labour market firing, obviously there's sort of inflation risk there, but all of this is sort of happening as the Middle East conflict raises the potential for an inflation shock from energy prices. I mean, that's got to be a big factor as we look ahead.
Definitely. I should preface what I'm going to say by saying still early days, and it's hard to predict the full kind of fallout from that instability in the Middle East. But we have already seen, I guess, that instability flow through into higher oil prices, and that will flow through to obviously petrol at the bowser and inflationary pressures domestically. And it's probably happening at the point where the Reserve Bank, exactly at the point the Reserve Bank didn't want an exogenous shock like this to be hitting our domestic economy. They've got a domestic kind of, they're fighting domestic sources of inflationary pressures. This exogenous shock from external sector, adds to that challenging landscape. So I guess, it's quite a difficult place for them to be at the moment. The governor spoke yesterday about this, and they're quite aware of, the potential fallout on domestic price pressures and also inflation expectations. So if inflation expectations continue to rise or remain elevated, it'll be harder for the RBA to get inflation down. So, it's happening at the precise moment the Reserve Bank probably didn't want it to happen, but it's part of the landscape now, and it's something they're going to have to, I guess, address going forward. In addition to these domestic sources of price pressures.
And as you referenced, Michelle Bullock was speaking yesterday. Market expectations for a March rate rise rose slightly. She said every meeting's live. Do you think they'll have to pull the trigger in March, or is your expectation it will be May?
So we still think it'll be May. We still think that there will be an additional hike in May. But there are counter arguments, and you can make arguments for a March hike given how strong demand is growing on the back of today's figures. But I guess one factor that could keep them on the sidelines is what I said earlier. So productivity has bounced back. It's stronger than what the Reserve Bank themselves were forecasting for the December quarter. And that may just hold them off a little bit. They may reassess their view on the supply side of the economy, and on the back of that, have, I guess, the confidence to wait to May to see whether that's going to be sustained going forward, or whether inflation's going to surprise on the upside. So we're still sitting on May, but there's definitely an argument to be made. If you think they have to go in May, why wouldn't you just pull the trigger in March? So there is that argument, but as I said, it's based on the benign or positive productivity read from today's report. It could just hold them on the sideline for an additional few months, I think. So.